Wescott's latest market and economic update as of March 5th, 2021. I'm Carrie Delgott, Wescott's Chief Operating Officer, and I'm here with Mark McCarron, Wescott's Chief Investment Officer.
Thanks, Carrie. Happy to be here.
So here we are, nearly a year after the COVID-19 pandemic arrived in the US, and it seems like there's finally light at the end of the tunnel. New infections are coming down, and with the J&J vaccine being approved recently, the US now has 3 viable vaccinations available. It also looks like supply will be increasing dramatically over the next few weeks, which suggests that the worst of the pandemic may soon be behind us.
Yeah, thanks, Carrie. This is absolutely good news, and I think we're all excited to return to our normal way of life. And I think that's a good backdrop to put this week's economic and market update into some context. In fact, what we've seen this past week is some volatility. And the recent market volatility is not due to the fears of an impending economic recession like it was a year ago. In fact, it's the opposite. And there are a couple reasons for that. First, the market's expecting additional fiscal stimulus to be passed by Congress soon, which will help the economy. And the second is that, as you've mentioned, the continued rollout of the vaccines will lead to a lot more opening up of the economy, which will ultimately lead to more discretionary spending, on things like travel, restaurants, entertainment, and this will give the economy a much needed boost. I think the other thing, too, to highlight is that not only will there be more support from Congress, but this week's announcement by Fed Chairman Jay Powell suggested that the Federal Reserve is going to continue to support the economy with low rates. And they're going to do that until the unemployment rate gets to their target and inflation goals are met. And even though there's some talk about higher inflation, we're still well below the target the Fed has for inflation. And he added, by the way, that this may take some time. And I think that's why we're seeing the market movement, the market volatility that we have this past couple of weeks. The final thing I'd say is that the number of people getting back to work is increasing again. And this is bringing down the unemployment rate, which at 6.2% is still abnormally high, but there's an improvement. And I think the markets are looking beyond today, but for evidence of economic growth tomorrow.
Mark, you mentioned that this most recent bout of volatility was different than a year ago. And at that time, the uncertainty of the pandemic's impact to our economy caused investors to favor higher quality companies, those that were not only expected to survive, but really thrive in a virtual world. What are you seeing today?
I think the conditions that were driving the markets last year really actually have been in place for the last 10 years, the last decade, and particularly the last 5 since 2015. And that's where growth companies are outperforming value companies. We talked a lot about this. But I think some of the driving forces behind that, the low interest rate environment, the forced focus on virtual activity and also online shopping, all of those things have driven technology to record highs. But I think what's happening right now is that the optimism about perhaps the worst of the pandemic is behind us, with the vaccines becoming more available and more additional fiscal stimulus, the global economy looks like it's opening up and growing faster than anticipated. And that's what we're seeing today in the markets. That's what we're seeing in the stock market. We're also seeing that in the bond market. If you look at US Treasury yields, they tend to rise when there's high expectations of growth improvement. And now the yields on a 10-year Treasury are up above 1.5% for the first time in a year. For example, a year ago, they're only at 0.5%. And this is in response to these positive developments. So what we're seeing more recently is that since November of last year, really when the vaccine announcements were made, the market leadership has started to rotate from growth to value, as what we talked about before, the pandemic trade giving way to the recovery trade. Rising bond yields, as we talked about, tend to happen in this environment, and they are putting pressure on growth stock valuations, which have led the equity sell-off in recent weeks, as you can see in the orange line here. While the market is falling, it's been growth that's leading the drive down, whereas last year it was value. So it's almost a totally different and totally opposite dynamic. In fact, as expected in this environment, value stocks have held up better, given their larger allocations to things like banking, energy, industrials, all of which tend to do better when economic conditions improve.
It certainly does seem like the leadership in the market is changing and changing rather quickly. We've moved from fears of a recession to concerns that the economy will overheat in just a few months. What does Wescott expect for the rest of 2021, and how are Wescott's portfolios positioned for this environment?
Well, first, we expect the recovery that we've seen since November to continue throughout this year, because the economy we expect to continue to open up even more than it is today, and that will drive a lot more activity. For example, consumer spending will continue to rebound because there's a lot of pent-up demand, and that will drive growth in the second half of 2021. So very importantly, Wescott's portfolios, I think, are positioned well to benefit in this environment. First and foremost, the portfolios are less concentrated and much more diversified, which as a market broadens, the economy broadens, so does the performance of client portfolios. And really importantly, what we've seen is the most expensive stocks being sold down these past couple of weeks, and Wescott portfolios are underweight the most expensive stocks, really as a matter of philosophy. The tilt that we have in portfolios toward undervalued stocks is being rewarded today and should continue as the economy rebounds. And on the bond side, we have less interest rate risk in the market. So bond markets are weak, yields are rising, but in Wescott portfolios, we have less exposure to that dynamic. So in general, I think in summary, we're well positioned to benefit in this environment.
Thanks, Mark. Great perspective on the ever-changing market and economic environment and how Wescott's portfolio strategy is well positioned to benefit in this recovery. As always, please don't hesitate to reach out to your advisor with any questions, and thank you for your trust in Wescott.
Thank you.